I'm here at the London Stock Exchange, where I've been chairing a business awards evening. The trouble is, the stock exchanges themselves raise a fundamental question. Is it actually a good idea for a company to raise money on a stock exchange through a public offering, or are they better to be privately owned? Now, there are many companies that have been faced with this challenge. There are companies that have been privately owned that have then come to the stock exchanges to raise capital, and that's what stock exchanges are brilliantly designed to do. The trouble is that as you do that, you often land up with institutional shareholders and a whole host of other complex problems, and find yourself answerable to people on a quarterly basis, and then it almost seems like a weekly basis, where if you don't make your numbers for 2 consecutive quarters, then it seems that the company is in crisis. Whereas private equity owners, family-owned businesses, businesses which are owned by their employees, tend to have a more mature view. They tend to take a longer view than the next 12 months figures, or the next 3 months figures, or even the next week's figures. They tend to have a commitment to that stock which transcends a short-term wobble. They tend to think about an investment that will produce a return in 2 years' time, or 3 years' time, or 4 years' time. And you see this, for instance, in privately owned companies, companies owned by private equity, which have been designed, perhaps they've been taken out of the stock exchange frenetic environment and into the calmer influences of private equity, and then to be managed, to have more life coaxed out of the business, and then to be floated maybe in 2 or 3 years' time. And then you find the focus is not so much on what the next 12 weeks is going to be, but in what shape will this company be when we want to bring it to market again in about 3 or 4 years' time. So it's a different kind of psychology. And I see it quite vividly because I work with so many huge multinationals that operate in maybe 10, 15, 20 or 100 countries each. On the one hand, ones that are listed, and on the other hand, some companies that are privately owned. And the privately owned ones have a completely different atmosphere about them, which is fascinating and, I have to say, quite attractive and endearing in some respects, with, as I say, a much more personal focus, a much more emotional commitment, and a much longer-term vision. So we'll see these issues played out. One of the challenges is for analysts to take a longer-term view, because it's quite easy for analysts to destroy businesses by preventing them from investing in the future. How can you possibly build a business on a secure basis for 3, 4 or 5 years' time when you are putting money into long-term stuff? Now, of course, pharmaceutical companies have to do that all the time. They have to take a 15-year view. It takes 15 years to take a product through the pipeline to market, if you're lucky. That is, if the product doesn't turn out to be faulty in some way or have no impact. Then you have maybe 10 years to market it before its patent expires. So they have a 25-year view. Energy companies often have a 25 to 30-year view when they're maybe digging a new oil well or something like that. So the market tends to tolerate longer-term decision-making in those kind of sectors. But in financial services, for example, the market can be very intolerant of a 3-month blip or a 6-month disappointment. And it can be the same also in retailing. The people tend to think, well, you're only as good as your last January sale, which is crazy short-termism, when there may be fundamental things that are happening to the quality of the brand itself. There may be a raft of new changes taking place which will give a greater penetration into, so let's say, emerging markets over the next 3 years, and so on. These things require a sophistication in our judgments about the value of companies, which I have to say, I think are way beyond where some analysts are today.